In this week's assignment, you're going to have to create a cash flow statement. A cash flow statement is one of the three main financial statements often found in business. And what it does is it tracks the receipts and the expenses, the cash receipts and the cash expenses associated within a business within, say, a given fiscal year or a given time frame. And it is actually broken down into three main sections. The first main section is this cash flow from operating activities. The second section is this cash flow from investing activities. And the last section is this cash flow from financial activities. Now we're going to use this video to talk about how you set up a cash flow statement, because that's going to become necessary for the actual assignment. So whenever you're setting up a cash flow statement, the first thing you want to do is you want to give it this little header up here. And you want it to say cash flow statement, followed by the company name, and then you want it to say fiscal year ended, say, 31 December of 2017. And you want to make sure you have this title, company name, as well as when the fiscal year is ending. That becomes very important because for some businesses the fiscal year may not end, say, on December, but it might end in, say, the end of September. Then after that, then the next thing we're going to put on there is this cash flow from operating activities. And what you'll notice is under this cash flow from operating activities, under the investing activities, and under the financial activities, they will have a revenue and an expense side. Now when we're talking about operating activities, this cash flow from operating activities, we're talking about the cash expenses and then the cash receipts associated with normal operational activities associated with the firm. So if this is, say, a farm or ranch, the normal receipts, the normal operating enterprises might be something like crops or livestock or anything of that nature. So something like receipts from crops, the amount of revenue you receive when selling all of your crops, that would actually go under this operating activities. If you were, say, a cow-calf operation, sale of the calves would be classified as this revenue from operating activities. If you were in a different business, such as the Apple business, or your Apple, their cash flow from operating activities would be, say, the iPhone, or the iPads, or the Apple Watches, or anything like that. So it's revenue associated with the normal products that you are actually selling. So what you do is you'll plug in those receipts from those crops or the livestock, or all of your receipts from these normal income producing enterprises, and then you'll add all of those up to come up with the total receipts. So then after you have the receipts from these operating activities, you need to dive on in and to find these expenses from the operating activities. Again, the expenses are normal everyday expenses that you find in a firm. So for an agricultural operation, it might be something like labor, fuel, feed, seed, income taxes. That's actually going right here. Interest expense on loans, such as an operating loan. That is actually a normal expense that would go under these operating activities. So then after you add up, or after you get all of these in place, then you need to add up these total expenses. And then you need to calculate the net cash flow from operating activities. In order to calculate the net cash flow from operating activities, you're going to take these total receipts, or you can see this formula down here. It's line 1 minus this line 2 equals line 3. So it's receipts from operating activities minus these expenses from operating activities to find the net cash flow from operating activities. So this will let you know whether or not you made or lost money on normal operating activities, these normal operations of this particular firm. The next thing we're going to look at is this cash flow from investing activities. Whenever we start talking about investing, we're talking about investments. These investments could be the sale of an asset. They could be the purchase of a fence line or improvements on your property, the purchase of property, the purchase of new equipment, the purchase or sale of something like financial assets such as stocks or bonds or anything of that nature. These are dealing with investing. Whenever you're investing in the business, whether or not you're investing in new equipment, New property, new buildings, stocks, bonds, anything like that, that's going under investing activities. So the revenue from investing activities, or that money would be coming in from the sale of assets, something that you already own and now you're selling. That could be used equipment, that could be brand new equipment, that could be the sale of stocks or bonds, anything of that nature. Then once you get all of that put in their proper places, you'll add up all of those sales to find the total receipts from investing activities. Then you do the same thing, only on the cost side, the expenses side. So whenever you're dealing with expenses from investing activities, you're dealing with asset costs, these new improvements that you're buying. This is new equipment, this is a purchase of more stocks or bonds or anything like that. So land payments and equipment payments, as well as the purchase of livestock, such as breeding livestock. The purchase of breeding livestock would be considered an asset. You purchase say a bull, that isn't actually an asset because you're not looking to sell it. You're looking to actually use that in your business, and that's an investment. That actually would go under investing activities. So the purchase of, say, breeding livestock would go under a cost under this expenses from investing activities. Maintenance and repairs on equipment, that is all investing activities. Things of that nature. And again, you'll add up all of your asset costs, your expenses from investing activities, and then to find the net cash flow from investing activities, you take line 4, which is the total receipts from investing activities, minus line 5, which is these are expenses from investing activities. And that'll calculate the net cash flow from investing activities. You see, you calculate the net cash flow of investing activities in the exact same manner as this operating activities, how you calculate the net cash flow of operating activities. Now the next thing we're going to look at is this net cash flow for financial activities. These are often dealing with, say, loans and the financial aspect of, say, acquiring or anything of that nature, or payment of, say, an operating loan. Now we're going to make a distinction here between land payments and equipment payments. Those are actually going under investing activities because land and equipment is an investment. When we deal about cash flow from financial activities on a farm or ranch, we're often dealing with operating loans. So an operating loan is a temporary or maybe a 1-year loan, possibly 2-year loan, that goes to pay for the operating expenses of the farm or ranch. So if you don't have enough money to operate at the farm or ranch for the full year, you might go out and pull out an operating loan that you use throughout the year, and then you pay it off at the end of the year or the next year. So if you have to withdraw from the operating loan or take out an operating loan, that's money coming into the business. So technically that is a cash inflow from an operating loan, and that's considered revenue or receipts. So then you have usually cash flow from operating loans is going to be your total receipts or your revenue from financial activities. So once you have this cash inflow from operating loans and you have that in the right place, then you add up all of your total receipts, which in this case might only be receipts from the operating loan, and then you need to look at the expenses from financial activities. And that's going to be the payment of those operating loans. So you might have a loan wherein, say, the current year is 2016, and you took out an operating loan in 2015 and you have to pay it off. So you go ahead and you pay off that loan in 2016 that you pulled out in 2015. So the payment of that loan would be the payment of the 2015 operating loan. And if you pulled out any more operating loans in 2016, that would be the cash flow from the operating loan. So then after that, then you'll add up all of your expenses from financial activities to find out the total expenses. You'll take total receipts minus total expenses from to find the net cash flow of financial activities, just like we did on the other two sections of this cash flow statement. And then at the end of it, then you need to add up the net increase in cash. And what that is you're adding up this net cash flow of operating activities, that's line 3, plus net cash flow of investing activities, line 6, plus net cash flow of financial activities, line 9. You'll add up all three of those to find the net increase in cash. Now, net increase in cash may be positive or negative depending on the year or the business. So we're going to assume it's positive for right now. Then you'll take your beginning cash, basically whatever you had in your checking account at the beginning, that goes right there. And then your ending cash is this increase in cash plus beginning cash. So what you hope is that if the business is profitable in the cash flow sense, meaning you have more money coming in receipts than you did going out in expenses, this number would be positive. That added to the beginning cash would actually increase your ending cash, ideally. Now, not every business is going to make money or have more cash coming in than going out every single year. So as a result, this number might be negative on certain years. Well, you still follow the same process. You take this negative number, add it to the beginning cash, and your ending cash will actually be less than your beginning cash, which makes sense. You spent more than what you made, so it pulled on your checking account and dropped your checking account down. But essentially, this is a quick little review of how you actually come up with a cash flow statement.